Hey everyone, and welcome to this brand new explainer video right here on the Gap Advisors Ind AS Clinic YouTube channel. Today, we are going to explore a topic that honestly causes a lot of head scratching in the finance world: hedge effectiveness. Specifically, we're going to look at that notorious 80 to 125% rule under Ind AS 109 and see if a hedge is really strictly disqualified just because of a rigid percentage. Let's get right into it.
Okay, before we dive into the deep end, let's just set a few quick ground rules for our discussion. First, our functional and presentation currency here is the Indian rupee, meaning any currency other than the INR is treated as foreign currency. Second, our standard reporting period runs from the 1st of April to the 31st of March. And finally, just a quick disclaimer: the views expressed in this explainer are the personal views of the author and are not binding on the audience. We always highly encourage you to seek the help of an expert before taking or refraining from any action based on what we discussed today.
So here is our roadmap for today. We'll start with the hedge effectiveness query, then move into qualifying for hedge accounting, the objective of hedging, calculating and rebalancing ratios, and wrap up with some final takeaways and resources. All right, Section 1, the hedge effectiveness query. This whole discussion stems from an awesome query featured in the 217th edition of the Gap Advisors Task Weekly newsletter. It's authored by CA Manish C. Iyer, director at Gap Advisors, and published over on LinkedIn. Actually, they've put out over 230 editions so far, so if you're registered on LinkedIn, definitely go subscribe to that newsletter for free. Anyway, the querist basically asked, in the current scenario, can an effectiveness of 75% or 130% actually be considered acceptable? And does Ind AS 109 categorically prohibit the use of that old, familiar 80 to 125% range? It's a huge point of confusion, right? Especially for auditors and finance teams who spent years practically living by those strict old rules.
Which brings us right to Section 2, qualifying for hedge accounting.
To figure this out, we literally just have to look at what Ind AS 109 actually requires. If you check out paragraph 6.4.1, you'll notice something pretty wild right off the bat. Those rigid numerical thresholds, they're completely gone. Instead, the standard outlines 3 qualitative criteria. First, there has to be a genuine economic relationship between the hedged item and the hedging instrument. Second, the effective credit risk cannot dominate the value changes. And third, the hedge ratio must be based on the actual quantities your entity uses without intentionally creating some sort of imbalance just to achieve a specific accounting outcome.
You can see the paradigm shift clearly right here. Under the old regime, everybody was forced into this tiny, strict 80 to 125% box. But the new regime under Ind AS 109, it is entirely principles-based. That old rule has been completely replaced. Now, an economic hedging relationship works as long as the changes in fair value or cash flows offset each other. You get to determine what degree of offset is considered effective, provided that CVA or DVA, that's your credit and debit valuation adjustments, aren't significantly skewing the fair value.
Moving right along to Section 3, the objective of hedging.
So without those strict numbers, how on earth do you justify a 75% or 130% effectiveness? Well, Ind AS 109 is surprisingly liberal here. Paragraph 6.1.1 flat out states that the overarching objective of hedge accounting is to represent your entity's actual risk management activities in your financial statements. It's all about transparency. Because of this, getting an R-squared of 75% or 130% based on a multiple regression analysis does not automatically negate the instrument from being designated as a hedge. As long as it reflects how you're truly managing your risk, you're not immediately disqualified.
Okay, Section 4, calculating and rebalancing ratios.
Let's bring this down to earth with a real-world example. Say we are dealing with foreign currency risk between the US dollar and the Indian rupee, and we land on that 75% figure. If we ignore CVA and DVA for a second, an R-squared of 75% literally just means your hedging instrument successfully hedges exactly 75% of the notional value of your hedged item. It's just a ratio. So your hedge ratio for this relationship would be $1 of the hedging instrument to 0.75 US dollars of the hedged item. But remember, under Ind AS 109, this effectiveness assessment is made prospectively at the end of every single reporting period.
Now, imagine it's the end of the next reporting period. You rerun the numbers, and boom, your R-squared is now 90%. Notice how your hedge ratio just fundamentally shifted. It goes from 1 to 0.75 in the current period to 1 to 0.90 in the next period. The economic reality shifted, so your accounting absolutely has to shift with it.
To fix this imbalance and keep your accounting accurate, the company is required to rebalance the hedge ratio. You basically have two choices here. You can either designate an additional 0.15 US dollars of the hedged item, or you can de-designate 0.22 US dollars of the hedging instrument. You aren't failing some arbitrary test, you're just recalibrating your tools to match reality.
And here is the absolute crucial takeaway. Under Ind AS 109, once a hedge relationship is established and documented, you must continuously monitor and rebalance that hedge ratio as the economic relationship evolves. Voluntary discontinuation of hedge accounting is strictly prohibited. You can't just throw your hands up and opt out when the math gets a little messy. You have to rebalance.
Finally, Section 5, Final Takeaways and Resources.
Understanding this shift from rules-based to principles-based accounting is a total game changer. I want to say a huge thank you for your time today. If you found this explainer video helpful, please hit that like button, add a comment below with your thoughts, and definitely subscribe to the Gap Advisors Ind AS Clinic channel if you aren't already. Also, please share this video with your contacts, your colleagues, your audit and finance teams, and especially any students pursuing their CA course so we can really spread the knowledge of Indian accounting standards. Oh, and for a real deep dive into the issue we dealt with today, make sure you connect to the Gap Advisors Ind AS Clinic podcast, which you can find on Spotify, Amazon, or right here on YouTube.
One last thing. The issue and response we discussed today is literally just one out of thousands from the amazing repository over at gapadvisors.com. They host over 4,500 issues and detailed responses on Indian accounting standards and Indian GAAP. Anyone can register for free, submit issues on Ind AS and Indian GAAP, and get highly detailed responses delivered straight to their inbox. It is an absolute must-have tool, particularly for auditors who really need to document exactly how they addressed complex Ind AS applications. So head over and register. To wrap this all up, if the entire goal of your financial statements is to tell the true, transparent story of your risk management, why would you still try to force that new story into an outdated 80 to 125% box? Thanks so much for tuning in and keep learning.